What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. Today, Stephen and I will be joined by Jake Oubina, economist at Piper Sandler and one of the most thoughtful voices out there when it comes to making sense of the data that's driving markets. Welcome back, Jake, to our weekly podcast. So one of my favorite movies, it's an old one, it's Office Space. And one of my favorite lines in Office Space is, Peter, I see you've been missing a lot of work lately. And Peter's response is, I wouldn't say I've been missing it, Bob. So we haven't had any government data the last few weeks. Have you been missing it, Jake?
Not really. By the way, it's good to be on again, guys. I think, importantly, the two things that kind of the market looks at the most. So you got NFP and you've got CPI. I think you guys would agree with that as kind of being at the top of the list there in terms of what we've been missing. But, again, and I've argued this in the past, NFP has so many issues with respect to reflecting reality. I think the alternative data on that front has actually been better. If you look at things like ADP, claims, we're still getting claims. Guys, the state level stuff still comes out. States are still reporting claims. So we have to do a little bit of math around that because we don't get the official report. But we know that claims have basically been moving sideways at a pretty good level, 220K-ish. So nothing's changed on that front. And then, we have all kinds of private survey companies that put data out. The PMIs are still coming out. So we still have information on employment there. We still have information on prices. Paid versus received, I think, has been a really interesting thing to focus on with respect to margin compression from tariffs. So we have enough information to kind of still know what's going on here. On the inflation front, look, they had to get this number out because of all the COLA adjustments. It's the end of the fiscal year. Doesn't look like we're going to get an October print. We're at the 24th now. The government reopens. They have basically 1 week of collection. They've reopened today, and that's highly unlikely. And so the likelihood is October, they put in some placeholder, maybe a zero, because they actually observed zero prices. And then we get a November print that kind of makes up for that. And we take the average of those two. Hopefully we would have resolved that by then. But there's also alternative data on that front. There's all kinds of price statistics on goods. We've looked at the Adobe Digital Price Index in the past, hundreds of millions of SKUs every month, leading indicator of CPI goods. We have data on shelter inflation that's timelier, more relevant than what's in the CPI. You look at apartment rents, which have been deflating for 12 to 18 months. We're still getting that data. You look at single family rentals, 1.5% year over year, weakest in 15 years. So we kind of know, even from a leading indicator standpoint, what's happening, what's likely to drive these numbers that have been missing over the next several months. So I would say we haven't missed it. I think the good thing is that we've been able to steer people to maybe focus on a lot of these alternative things that in many ways are more valuable than the official numbers.
I think one of the things you guys do really well, Jake, is you corroborate all this data, which, I think there's been so much weight put on non-farm payrolls over the years, and it's the most forecasted data point. It's the most watched time of the month of the financial networks, and it's also the most revised data. So it's just like a good example of garbage in, garbage out, amplified. So hopefully I agree that this does broaden the perspective on data that people start to appreciate. But again, I think you guys have always been ahead of that in corroborating that. So we got inflation. We're recording this on Friday. What's your quick takeaway from today's CPI report, which is a little bit old, but markets are going to look like they're taking it in stride and hitting new highs?
Yeah. So our view going into this thing was more of the same, with the caveat that you had this interesting development in the owner's equivalent rent component, which weirdly was up a lot in August. So our view was, look, if you get any kind of payback for that, and historically you do, not sure why, again, talking about the faults in the government data, it's a 6-month moving average, 6 panels, not sure why it's so volatile. Topic for another day, perhaps, but that thing came in at 110, right? And so we did get a 2/10 because we did get some unwind there, but otherwise pretty much similar to what we've been getting, I would say, in the tariff war window. So post-Liberation Day, what you've seen is a clear break higher in CPI core goods X autos. And the reason we look at that is those are the things that are most sensitive to imports, import prices, tariffs, et cetera. That thing is now up. So through September, if you kind of baseline it off of a 2023-24 trend, so if tariffs had never happened, that's kind of your counterfactual, we're about 160 basis points above that trend. And there's been a clear break post Liberation Day. So you're getting some price pass through into the goods space. But the good news is you're actually getting some disinflation trends when it comes to the core services component. So if you look at super core, which is just X energy services, X the shelter components of OER and rent, that's 100 basis points below that 23-24 baseline trend. And that's a much bigger weight than the core goods. It's at least twice as big as this core goods measure. So overall, inflation is actually basically in line with your, had there not been a trade war baseline view. So when we look at the pass-through to the consumer, which I think has been critical in terms of dictating the narrative around what's happened with employment, there's been some pass-through in goods. Companies have been successful there to some extent. But when you take it holistically, there's been really no pass-through to the consumer because there's been disinflation on the services side. And so from our lens, you look at that, you look at the fact that import prices, so this is, are exporters into the US making any concessions there because of tariffs, trying to stay competitive, et cetera. Import prices, and we don't have new data for this because that's one of the things that's being delayed, but they were down only 20 basis points from trend through the August print. So there's been very little price concession overall from exporters into the US. So it's been really a margin problem for companies overall. And I think this is why you've seen a deterioration in the jobs numbers. I mean, it's not a coincidence that jobs numbers started deteriorating more meaningfully in the big tariff war window, right? And this is companies trying to manage margins through one of their big levers. And so, we've highlighted this, but you look again, alternative measures, right? Conference board, jobs easy versus jobs hard to get, kind of corroborates the unemployment rate. And it broke to the upside. It models to something that's north of 5% for the unemployment rate now. So consumers already feel like it's 5%, right? Nancy's been saying this for several months now. Small business, another alternative data point, kind of corroborating what's been happening, hiring intentions. Now they've bounced back a little bit recently, but they really gave up the gains that you saw post-election when the sector was very excited about the backdrop, really gave it up once tariffs started going up. Again, another data point that's consistent with 5%. Now, if you make an adjustment to unemployment for the fact that the labor force growth has been slowing this year, not population, labor force, so participation rates are down, unemployment would already be 5%. So it's this labor force participation slowing that's kept the unemployment rate from going up more significantly. But again, you tie it all together, it all fits, right? Companies are seeing margin pressure from tariffs, which act exactly like a tax, the inability to pass price on broadly, yes, in certain pockets, which is what we continue to see in the CPI. And then this manifesting in, well, I've got to try to manage this somehow. So I am going to flow the hiring process here. So we've had a stalling out, a slowing on the hiring side of the equation. Not a lot of firings. It's not your classic late cycle sort of firing cycle. Claims are still very low, but the hiring has stalled, and that's been enough to slow down jobs. So I think what we've seen in the CPI, what we saw in the CPI and the latest CPI is just a continuation of this process. And so when you look at the next couple of months, I would imagine that the labor market continues to deteriorate, at least on the margin, with respect to what's been happening with pricing.
To me, it feels like the last 12 months, the message has just been more of the same. And, we're in this kind of glacial macro slowdown. We really haven't had a business cycle in the last few years. You and I have talked a lot about this. The housing data has just been sideways. The manufacturing PMI data has been sideways. And, you've got strong parts of the economy, you got weak parts of the economy. And, one of the things I think you're very right on, you just pointed out that, I think people see the labor market data weakening. And because putting aside COVID, the last time we saw the labor market data weakening, which was 07 and 08, it's just amazing how the psychology gets people wrapped back up in that thought process. Just like today, you just said, and I agree with you, we're kind of back to like base trend level inflation data, yet everyone's so focused on inflation and still fearful of a rebound in inflation. And I can only imagine if we got in our DeLorean and went back 10 years with today's data set, you would have talked about CPI for about 2 minutes and we would have moved on.
CPI was always 0.2 every month.
Yeah, but and nobody cared about it. And now it's, maybe it's overtaken the labor data. I think actually probably has in terms of macro importance in the minds of investors and businesses. And of course, I think people are conflating price levels with inflation problems. But if we're going to have an inflation problem, where do you think it could come from? And I mean a problem, right? If it firms up or remains sticky, I don't see that as a problem, though investors may. But where could things
So
deteriorate?
yeah, and I agree with you. I mean, and the problem is we do this as a market investment community. The Fed does this as an institution, but we're always kind of fighting the last war, right? And so obviously the inflation shock of COVID is still top of mind for a lot of people. And the kind of revisiting of that is a paramount risk in people's heads, even though I think it's a very small one. What could cause it? It's always about monetary expansion, one way or the other, right? It's fiscal outlays shooting up in an aggressive way over a short period. It's bank credit expanding very substantially. These are the two critical ways that you can add money in the economy over a short period. You look historically, well, we don't have to look that far, right? COVID, we spent $4 trillion more than we were supposed to, than we were expected to. Fed monetized it. Boom, you got massive inflation. CPI shelter at one point was annualizing at 12.5% on a 6-month run rate basis. Once you switch that to, well, we're still spending a lot, but our spending cadence is now in line with where we were pre-COVID in terms of the rate of change. That melted down. Once the Fed started doing QT, that melted down. CPI shelter went from 12.5 to slight deflation in late 22, and it's been 1.5 since. So that's the near-term example. Historically, the 70s, right? I think what a lot of people forget about the 70s, yes, there was a lot of policy mistakes from price level fixing, obviously the delinking of the dollar gold peg and all this other stuff. But we had two massive credit cycles in the 70s where bank lending was up 20% each time plus. And these cycles both led to cadence in overall headline inflation. So you were creating money in the economy vis-a-vis bank lending. When a bank lends, they create more deposits. And like COVID, you had these inflation cycles that followed that. We don't have anything like that right now. I would say from a very short-term standpoint, what's one thing that can give you maybe slightly hotter inflation? Well, we do have a fiscal impulse coming from tax changes. The refund season, Don wrote about this, I believe, last week. And we leveraged some of his work here in terms of how we're thinking about the consumer in the first half. But the tax refund season, I mean, it looks like you're going to get 90 billion more over this year. That's 50 basis points on consumer spending. So it's not a huge inflation risk, but over a short period of time, if you don't have enough inventory, if there's a mismatch there, you could see maybe some slightly hotter prints. That all fades into the background though, right? These are temporary, very temporary phenomenon. I've heard people talk about, well, we've got this big AI CapEx build out. Obviously, utility prices are going up. You're seeing this in pockets across the country where it's become a very real headwind for households. I mean, doubling of utility prices plus, right? And this is being interpreted as, well, it goes into everything. It's an input. Doesn't that then lead to prices going up, right? And the reality is it doesn't. It acts exactly like a tax. I mean, you could think about this just fundamentally from a household budget standpoint, but you could also model it. And if you shock electricity prices, no pun intended, if you shock, nat gas prices, et cetera, historically, what you notice is that it reduces real consumer spending because it crowds out spending in other areas. Consumers are budget constrained. They have to decide what to do with their dollars. And so I view all these idiosyncratic price changes that are very real on a component by component basis, especially with respect to the AI kind of boosting energy utilities, et cetera. You have to think about them in the context of a consumer that's budget constrained. And unless you provide an offset to that, and whether that's fiscal stimulus, whether that's credit, you do not get inflation. You get relative price changes ultimately.
So I'm an old school inflation watcher with respect to energy and the consumer. And, oil prices, gasoline prices, the real levels of these things are ridiculously low. But again, like you mentioned, all the focus has been on rising electricity prices. So I haven't dug into the data, but I'm sure you have. What is the rise in electricity being, is it offsetting the benefit to the consumer, or is it more of an impact issue for manufacturing? I guess, how do you see that currently playing out, and how is the energy component of inflation behaving? And are you picking up any kind of nuances where, there is an energy inflation problem, but you're not going to see it in the price of oil or gasoline?
I think so far it's been relatively muted when you look at holistically across the United States. I think there's definitely pockets where it's a problem, right? And I think the Journal had an article on this last week or over the weekend on specifically regions that are seeing this as a problem for household budgets. So, you look at electricity, for example, in the CPI, we're probably 2% above kind of a 23, 24 baseline right now. That's nothing. This thing swings around very substantially. Natural gas, up a lot more there, call it 15%. But there you've gone from a deflation phase where nat gas prices were very low to then a normalization phase. So we're still relatively tame when it comes to the broad picture for the consumer. But if you highlight it as a risk, we've done some modeling around this. Basically, every standard deviation shift you have in utility prices will have a reduction of about 10 to 15 basis points of consumer spending, is the round numbers on this. So it acts very similarly to what you get from oil shocks historically, or, vis-a-vis gasoline prices going up. Yeah. So I think there is something to that. We're not at the point yet where we've seen enough lift nationwide in those pockets, but I think it's definitely something to watch as we move through 2026 in particular. Yes, we've kept the commodity side of energy relatively low, and it's going to be a headwind on October CPI, which will get released. But we've seen that come down. But you have this offset, which I think is important to keep in mind on the utility side. But again, how we're thinking about this is it creates a phenomenon where consumers will have to make a decision about consumption. And utilities are very inelastic. I would say they're more inelastic than gasoline prices. You can still go to the pump and say, give me $20 and maybe you're buying less gallons, right? But are you going to turn off your heat in the winter because your utility prices are higher? Are you going to heat your house less? I don't know. I don't think so. I think there's probably less elasticity there. So from a crowding out standpoint, it's probably a bigger story than what we're historically used to from the gasoline side. But it's something that we're continuing to explore. And I think it's something we're thinking about for 26 as well.
Yeah, it's certainly AI definitely creates a kind of a new normal for thinking about energy risks. I think you could argue back into 2012 where shale really became a big part of an energy production in the United States really started to boom, that the risks of oil prices kind of shifted with respect to the overall economy. And of course, now AI is perhaps internally shifting that again with respect to nat gas.
But also, what I'll say on that, though, structurally, that if you're taking a multi-year view here, is that to the extent that these investments in productivity enhancing CapEx, which AI is probably the one with the biggest multiplier, if you think about the downstream applications from that in terms of increasing labor productivity, that is a very deflationary phase, right? Like that's a phenomenon that's super deflationary. So yes, some relative price increases on the utility side, but everything else is probably getting cheaper, with the path least resistance being one of deflation in a lot of these areas that implement a lot of this. And this is not something that, yes, AI has taken the next leg of this, right, in terms of accelerating the process of productivity enhancing CapEx, but this is something that really started, 2011 post GFC, where, and I've written about this in recent months, but we've doubled our investment in productivity enhancing CapEx per employee in units terms, right, in inflation adjusted terms since 2011. The AI thing has just really made that curve more exponential. And it's akin to what we did in the kind of early to mid 90s tech revolution as well. So the IT revolution back then. And that yielded a lot of productivity well into the early 2000s, which is why we were able to carry decent growth, even with a jobless recovery back then. And we've seen the productivity versus hours divergence this time as well. And I don't think it's AI yet. The implementation has not been that ubiquitous, but we've seen output go like this, output and to the right, and hours kind of flatten out. And this has been since 2023. So I think that we're going to see a lot of dividends from improved productivity. And that's just from a context standpoint, deflationary historically.
From a consumer sentiment, do you think, that data continues to just be generally, on the popular metrics like Michigan, it's still been pretty weak, and real income expectations, and you mentioned people thinking they're going to be losing their job or the unemployment rate's going to go up, has gone up. You think part of that is just the persistent AI news and this hyperbolic fear that, no one's going to have a job at some point?
I think that's out there somewhere, kind of beneath the surface. But I think the thing that's done the most damage here has been kind of the manifestation of a weaker labor market vis-a-vis what tariffs have done. And I would also say, though, the interesting thing there is very, we've used this word before a lot, bifurcated. And it is, right? It's this K-shaped economy reference. You look at what's the probability of losing your job over the next 12 months? And you look at the income groups, 50K or less, right? That's been going straight up since Liberation Day. Yeah. And it's at a local high right now. It was a little bit higher in late 23 when we had a little bit of a soft patch going on, but it's been straight up. And it's the opposite for income groups over 100K. That's been coming down despite, uncertainty still high, unemployment softening, right? There's been a clear indication that there is a softening in the labor market there. But, the wealth effect supports that idea, right? Market's still kind of trading at the all-time highs still. And so people still feel good, and that gives them a sense of confidence over the job market as well. So the juxtaposition is really interesting there. And it's labor market, job loss probabilities, and it's also income growth. Like you look at the 100K plus, their income growth expectations have been actually ticking up recently, while all the other groups have been ticking down. So it's more of this K-shape. The good news is, and we've referenced this before, but the top 10% of the country controls about 50% of labor income, and they control about 75% of assets. So that's been carrying the day for the last couple of years.
Yeah.
It's just become more extreme now. And I think this has widened in the advent of us being in this big tariff window.
Yeah.
So I think you got to take the confidence numbers with a lot of context, right? The headlines are not market cap weighted, if you want to kind of look at it that way. Whereas you look at the internal, and if you were kind of to do a market cap weighted confidence, right, where you're going to give the top 10%, a lot of weight given their control of assets and income.
Yeah.
I think we would look okay. Certainly not great, but okay, especially within the context of the tariffs.
I think that's a super important point, because a lot of people look at some of this data and a lot of the weak data and think, oh, well, the market's just going up because the Fed's cutting and printing money and deficits.
Yep.
And reality is, there's some of these data are diffusion data points that don't reflect a cap weighted market or really the share of spending and consumption, et cetera. So I think it's a really important point that, when I hear somebody make those points about how disconnected the economy and the stock market are, well, if you're looking one on a diffusion basis and the other one on a cap weighted, S&P 500 basis, you're not really looking at apples to apples. And, certainly not in recent years, where the composition and concentration of the stock market, just like the economy, has gotten much more narrow.
Jake, incredibly interesting. I like how you're thinking about it. That's a lot how we're thinking about it. You have all of this news and a lot of these idiosyncratic pressures. So you have a lever where something goes up, but it has a counterbalance to it. And the underlying aspect is you still have a strong consumer and a positive economic outlook. What are you thinking for the next couple of years in the road ahead?
Yeah. So, things change so quickly. Maybe I won't go out 2 years, but maybe the next 6 to 12 months, because a lot's going to happen in that window. Look, I think it's clear to us, and we talked about inflation, we've talked about employment, the manifestation of tariffs through margins, I think, has been the primary here. The court ruling on Trump's use of IEPA, super critical from a timeline standpoint. Obviously, tariff negotiations, et cetera, are also important, what happens with China, et cetera. But I think this IEPA decision is critical. It's almost like a fork in the road. The reality is, look, and the policy team's done a lot of work on this. They're going to try to do other things, 232, 151, et cetera. But I think it's going to be very whack-a-mole, much less effective than having this broad, sweeping, blunt tool of IEPA kind of exerting its power on the tariff conversation. And, the math on this, right now we're running at about a 10% effective tariff rate, 10 to 11%. IEPA goes away, you're down to like 4, right? We were 4 in late 19, early 20 after the ramp up with China. That decays organically because companies find a way, they reroute trade, they find substitutions, they find a way to pay less tariffs ultimately, right? And so I think the path of least resistance for tariffs, and I hate to put a point estimate on it because it's so in flux, but I think probably going to be well below 10% as we move through 2026. And that's a relief valve. That's one relief valve for margins for everything that's been on the negative side of the ledger for employment. So companies can, start hiring again, et cetera. But then we have 2 important tailwinds as well from the fiscal side, which one of which is the CapEx depreciation provisions in the OBBB, which again, by our math, you are giving businesses in America about $300 billion more in depreciation than what they had previous to the bill passing. That's going to go, and, people have different views on this, and we've had a lot of debate on this with clients. Does that mean CapEx has to go up? Well, maybe not, but one of 3 things is going to happen, or a combination, right? More hiring, more CapEx, more buybacks, right? Which is what you saw like in 2018, post the big drop in corporate taxes. We're still leaning in the direction that, look, this will be positive for CapEx, especially with some of the things that have a shelf life, like manufacturing structures, which sunsets in 28. So we're still very positive on the CapEx story, but regardless, it's a positive lift to the economy through multiple mechanisms. And then you've got the refunds that we touched on a little bit and the individual tax changes, which I think are going to make for a very strong consumer in, kind of the tail end of Q1, early Q2. First half of the year, I mean, you could see a 4% consumer on average quite easily, especially when you look at, the comp from the second half of this year, which again is plagued by headwinds, right? So 3% GDP for 2026 off of a compromised 2025 where tariffs were kind of taking up all the oxygen, increasing uncertainty, having a real effect on hiring decisions, et cetera. I think 3% is easily achievable next year. And the inflation story kind of remains one of continued progress where shelter continues to catch down to reality, where rents are deflating, inflating at the lowest pace in 15 years, depending on how you look at it. That will be reflected in the CPI components. And maybe you'll get a little bit less of this volatility in relative price changes if tariffs do get whittled down, less goods pressure, maybe a little bit more pricing power on discretionary services. So change in the internals there. But overall, I don't see any reason why inflation shouldn't be at or below target as we move through 2026. So a pretty Goldilocks year when you think about it from kind of the two big forces in the economy, real growth and inflation.
Well, putting that all together, Jake, I think that sounds like a pretty continued bullish outlook for equities. Certainly, if the labor market stays healthy enough, then earnings are going to keep moving higher. And I would probably say that the risk to markets is that the economy does surprise to the upside, perhaps too strongly and too broadly, and we see interest rates back up and some multiple compression, which again, I think would be more temporary and perhaps a slight headwind to offset any improvement in earnings. But that's the way we see things. But I agree with your Goldilocks assessment, and we look forward to talking again soon. And maybe the turn of the year, we'll catch up with you and talk about your 2026 outlook a little more specifically.
Guys, it's a pleasure.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.